Hello, everybody. Welcome to the KyebyeWay, where we make investing so simple that you'll be ready to invest with confidence. I am Aditya, and I'm here to teach you one simple rule: know your exit before you enter. And that's exactly what Kyebye stands for. So, we'll be bringing you the same video in English, Tamil, and Kannada. So, let's grab a seat, relax, and decode investing and life one step at a time. Yep? Come on, let's go ahead. In each module, we'll explore the investing and life principles of one iconic investor with the hope that their wisdom will inspire and guide us in our own journeys. Yeah? Today, we're going to see an interesting story of one of India's top investors. Born in 1954 in a middle class Marwari family in Bikaner, Rajasthan, his family later moved to Mumbai where he grew up, and he briefly attended the University of Mumbai but dropped out before completing his degree. His family was involved in a small ball bearing trading business, and he worked alongside his father before moving into the stock market. His entry into the stock market and his career in the stock market began after the untimely death of his father. He started as a stockbroker in the early 1980s. Despite his late entry, he became one of the most respected and low profile investors in the Indian stock market. His strategy was very simple but very effective. He believed in long term investments and in quality companies. He avoided speculative trades and focused on value investing, drawing inspiration from legendary investors like Warren Buffett, who himself is a value investor. And his initial breakthrough was during the early years when he became closely associated with notable stock market operator like Harshad Mehta. But when Harshad Mehta's stock market manipulation scheme was uncovered, our man profited by taking short positions against overpriced stocks, which significantly boosted his wealth. So this gave him the initial push, which was very important in his journey. And from there, his transition to retail. By the late 1990s, he began to shift his focus from the stock market to the retail industry. He noticed that the untapped potential in India's growing middle class consumer base was very big, which is what gave him the idea to contribute something to the common man. So that is where the birth of biggest chain of retail stores in India took place. In 2002, he founded India's largest chain of retail stores, a chain of hypermarkets under the parent company Avenue Supermarts. His approach was very simple, just like how it was in the stock markets. In retail, also, he was very conservative but highly effective. He ensured that his stores maintained a low cost, no frills model, focusing on groceries and essentials at lower price than his competitors. So he was okay with a little low margins, but he ensured that he gives quality product and something that was better than his competitors, so which could help the masses. He also preferred to own the land where his stores were established, so ensuring control over operating costs and minimizing rental expenses, which was a masterstroke. His slow but steady expansion proved immensely successful. After a few years, unlike many other retail chains that expanded aggressively, his chain of stores focused on profitability from day one, growing cautiously but profitably. By 2017, his company went public with an initial public offering, which is called as IPO. The company's shares were oversubscribed 104 times. Don't worry if you don't understand all these jargons. We are going to cover all these things as we proceed in our modules. Okay, so this showed the investors' confidence by oversubscribing, by his shares getting oversubscribed by 104 times. After the IPO, his net worth soared and he became one of India's wealthiest individuals. The IPO initially, the price band was set at 295 to 299, let's say around 300 rupees. But the confidence that the retail investors and the other investors showed in his company proved to be a blockbuster hit, and the company's shares gets listed in the share markets at around 600 rupees per share. So straight away, if you had invested 1 lakh, you would have got 2 lakh rupees. So that was a kind of blockbuster breakthrough that our man got it. So even after so many years after the IPO, his chain of stores continues to be one of the most successful retail chains in India, known for its cost efficiency, customer loyalty, and robust financials. His personal wealth has grown significantly with the company's stock price, and he is now considered one of the top billionaires in India. He is known for his simplicity, humility, and low key lifestyle. Despite his immense wealth, he avoids the media spotlight and is rarely seen giving interviews. His business philosophy emphasizes patience, long term thinking, and a focus on fundamentals. Any guesses whom we are talking about today? I'll give you 3 seconds. Three, two, and one. Alright, let's go ahead and see who this person is. He is Mr. Radhakishan Damani, India's own humble billionaire, Mr. Damani. And you'll be wondering, what is the name of the company that he started, right? Yes, we did see the parent company's name, Avenue Supermarts, but what's the brand that he created? Well, let's go ahead and see that. Yeah, now I'm sure you all know whom we are talking about, or at least the brand that he's created. Yes, my friends, we are talking about D Mart, which is actually the brand name, and Avenue Supermarts is the parent company. So this, my friends, is the price chart of D Mart or Avenue Supermarts since inception. Okay, so from 600 rupees to getting listed to 5,219 in about around August of 2024. So again, let me make it clear, this is not a stock recommendation. This is a chart just to show you what hard work, perseverance, and long-term thinking can do for you. Okay, so this is the company that Mr. Damani started, and this is where his stock price is today. So as we speak, Mr. Damani's business empire extends beyond DMart. He holds significant stakes in various companies, including VST Industries, India Cements, and Radisson Blue Resort. But my friends, again, as I told you before, this is not a stock recommendation. This is just to show you how Mr. Damani never forgot his roots. He came from stock markets and he still picks very good companies, which is based on value investing, which he believes that he should hold for long-term wealth creation. Yeah. So Mr. Damani has also inspired a generation of investors and entrepreneurs in India with his disciplined and thoughtful approach to both the stock market and the retail. Despite his immense success, he remains grounded, focused on creating value for customers and shareholders alike. What a brilliant man. So let's not forget what Mr. Damani's core principle was in his investment journey. Think long term. Do not be a speculator. Do not be in a hurry to make quick bucks. Let us be an investor and think long term, which is eventually going to help us create wealth. So, my friends, let's quickly see what we can grab from Mr. Damani's investment principles. Number one, stick with quality companies. Do not invest in companies which you don't know. Okay, so make sure the company is really good, the financials are really good, and the promoters are good. So we will see what are all the components we need to look for in a company before investing. Okay, so from there Do not gamble with money. If you don't know, don't invest. Number 3, try not to miss an opportunity. 4, diversify. And the last one is think long term. So do not get involved in speculative trades. Think about creating wealth. Okay, so these are some of the key takeaways from Mr. Radhakishan Damani's investment journey. This we come to the end of Iconic Investors session, and before we move forward, let's not forget the KyebyeWay, which is nothing but know your exit before you enter. This, my friends, is going to be your ultimate investment mantra. Okay, this you will understand the importance of this as we proceed through the other modules. Okay, so let's head further. Financial terms to know. So before we proceed with the course subject, in each module we are going to be learning about a few financial terms which will help us throughout our financial journey. Okay, so today's topic is going to be assets. Assets are things you own that have value and can help you make money or provide financial security. It could be your cash, your house, your car, or even a simple jewelry. Okay, so if you need ever money, you can sell or use these assets to cover the expenses. So simply put, assets are valuable stuff that belongs to you. Clear? Brilliant. Now, the next financial term we're going to know is liabilities. So, liabilities are things you owe to others, like your debts or financial obligations. They also include loans, credit cards, balances, mortgages, or any other money you need to pay back. So, always beware of liabilities. Okay. So this is the risk that you need to be aware of. So in simple terms, liabilities are the opposite of assets. So they are the things that take money away from you instead of adding value. Clear? The next financial term in our list is equity. Equity is the value of what you own after subtracting what you owe. It's like your share of ownership in something. Let's, for example, take say you have a house worth 2 crore rupees and you still owe 50 lakhs on the mortgage. So your equity in the house is going to be 1.5 crores. It is nothing but equity is assets minus liabilities. So 2 crores minus 50 lakhs that you owe gives you your equity. Clear? So the next term that we're going to know about is inflation. This is extremely crucial throughout your investment journey. Okay, you'll understand the importance of this as we proceed. So let's quickly look at it. Inflation is when the prices of things goes up over time. For example, something that cost 10 rupees might cost rupees 15 in the future. This means your money doesn't buy as much as it used to, so you need more money to get the same things. You understand? So I still remember back then, around 20-25 years ago, I used to be able to buy a masala dosa for around 10 to 15 rupees. And the same thing cost me around 150, 200, even 300 rupee dosas are available today. Why so? It's because your money is losing its value and the cost of raw materials are increasing. And the concept is called as inflation. So this is something that you need to understand well. We will dig deeper into inflation as we proceed in our future modules. But for now, I hope you've got a gist of what I'm trying to tell you. Yeah? So the next financial term we're going to learn today is IPO, which stands for Initial Public Offering. An IPO or an initial public offering is when a private company sells its shares to the public for the first time to raise money. To expand, they need money, right? So they get into the share market, and the process is called IPO. So after an IPO, the company becomes publicly traded, meaning its shares can be bought and sold on the stock market. So let's imagine a successful private company, TechStart, They've been growing for years now and want more money to expand their business. So to do this, they decided to go public by offering shares of the company to the public through an IPO. So as I mentioned before, the process is called as initial public offering. Okay. So once the IPO happens, people can buy Techstars shares on the stock exchanges, making it a publicly traded company. So if you buy shares of Techstars, you now own a small part of the company and could benefit if its value grows. Clear? So with this, let's move on with the core topic for the day, which is investing. What is investing? Why should one invest in the first place? Let's dig deep. Investing in short is about putting your money to work to grow over time. Instead of just keeping your savings in a bank where it earns very little, investing gives you the chance to build wealth and achieve financial goals, such as buying a house, paying off education, or even retiring comfortably. Okay, so investment is something which is extremely vital for every single human being. If earning money is important, investing is twice as important because it'll help you reach your goal at a much faster pace if you invest in the right avenues. Okay, so let's proceed further. So what are the different investment avenues that we have? Let's quickly look into it. Number one, fixed deposits, or it's also called as FDs. Number two, gold. Number three, real estate. Number four, bonds. And the last one is equities or stock market. So we'll cover mutual funds also under equities itself. Okay, so these are the different investment avenues that one has if he or she decides to put their hard-earned money to create wealth. So as I mentioned, the different avenues are you can invest in a bank, which is open an FD. You can buy gold. You can invest in real estate, which means you can buy a land, piece of land, a house, or a commercial building, or a store, which gives you rental returns. You can invest in bonds or even the stock market. Okay, so these are some of the common investment avenues that we have at our disposal. So keeping in mind the concept of Kaibai, which is know your exit before you enter, which is our ultimate investment mantra, let's proceed further and see the first asset class, which is fixed deposits. Fixed deposit, which is also known as FDs, can be open. It's like an account, like how we have a bank account. This is called a fixed deposit account. And this can be opened in a bank or a post office or in an NBFC. What is NBFC? We will, don't worry, as I told you, we will dig deep about each and every jargons. Okay, so a fixed deposit is a financial instrument offered by banks or financial institution where an individual deposits a lump sum of money for a fixed period at a predetermined interest rate. So once the deposit is made, the money is locked for the duration chosen, and withdrawing it prematurely may incur a penalty. So this means before once you let's say I have a lakh of rupee and I want to invest in open a fixed deposit in it could be either a bank or a post office or an NBFC. So once I decide to do that, I go to the bank, I talk to them, or nowadays you also get the online facility where at a click of a button you can do it from your house itself through your systems, through your computers. So the bank tells you, let's say if you want to invest for a year, what is the interest that you're going to get? Interest is nothing but like the earnings for keeping the money in the bank or the post office or an NBFC. Okay, so these parameters are all predetermined, and even not just the interest rate, even if the time or the duration is also prefixed. This is something that you can decide on. It could be a month, it could be 3 months, 6 months, 1 year, 3 years, 5 years. So it depends on your risk appetite and the need for money. Okay, so let's say you invest a specific amount which is called as the principal. Okay, in FD for a predetermined period, let's say 1 year or 5 years, the bank offers a fixed interest rates, which is this is just a hypothetical number. So let's say 6% annually, okay, for the chosen period. Yeah. So at the end of maturity, that is at the end of 1 year, let's say, the bank returns the principal along with the accrued interest. So far, I hope it's clear, right? It's self-explanatory. I mean, it's very simple. You have a lakh of a rupee. You decide with the bank before even investing that I'm going to keep the money for 1 year, and the bank says, okay, if you're going to keep it for a year, I'll pay you 6%. Okay, so this 6% again, as I told you, this is just a hypothetical number. It could differ from banks to banks or different institutions like post office or NBFC. Okay, all these things when you go there, you'll be able to get a clear information. So after this, so just as I told you now, let's look at an example. As I told you in the previous slide, if you are willing to invest, let's say 1 lakh rupees in an FD for a year at an annual interest rate of 6%, the bank calculates the interest rates on the deposit for 1 year. Okay, so in this method, the interest is calculated based on the principal, and principal is 1 lakh rupees, right? So interest formula, the calculation for this FD is 1 lakh into 6, which is nothing but the interest rate, the interest that you're going to get, into 1. 1 is what? The year, the duration, divided by 100, which will give you 6,000 rupees. So after 1 year, the interest earned will be 6,000 rupees and the maturity amount will be 1 lakh 6,000 rupees. Clear? Clear? So benefits of fixed deposits are you get guaranteed returns. The interest rate is fixed, so the returns are predictable. The risk is very low because it's one of the safest investment options, especially for risk-averse individuals. Okay, because you're going to be investing your money in a bank or a post office or an NBFC. Okay, and you also get flexible tenures. That is what one of the biggest advantage of FD is. So you can choose from a range of tenures from a few months to several years. Okay, and the rate of returns depends on certain factors. The rate of return on a fixed deposit depends on factors such as bank's policy, duration of the deposit, and the prevailing market conditions. So the longer you keep, the more interest you may get. So again, as I told you, when you try to open an FD, all the parameters are already mentioned there. So you can choose how many months, what is the interest rate, I mean not the interest rate, how many months you want to deposit, and based on the duration, your interest rates changes. Okay. So we just saw the benefits of fixed deposits. Now let us look at the disadvantages of FDs. Okay. So the first disadvantage is there is a lock-in period, which means when you invest in a bank FD or let's say post office or NBFC, you agree to keep the money in the account for a certain amount of time. So often this means that you cannot withdraw it until maturity. I mean, it's your money, you can withdraw, but it comes with a certain penalties. Okay, so once you give your word that you're going to keep the money in FD for let's say 1 year or 2 years or 3 years, whichever tenure you choose, you are supposed to keep the money there and not withdraw it prematurely. So if you do, there will be certain penalties that are involved. Number two, inflation risk. If inflation is higher than your FD interest rate, the real value of your returns decreases. This means that while you earn a fixed interest, the purchasing power of that interest may be less due to inflation. In simple terms, let's say as we speak now is what, November 2024, in India, inflation is around 4.5 to 5%. So the FD returns could range between 5 to 8% depending on whether you're a senior citizen or not, how long you're planning to keep, so the tenure, as I told you, all these parameters, right? So let's say hypothetically tomorrow inflation shoots up and it goes to let's say 8 to 9% or let's say 10%. which is not, I mean, it's a very rare scenario, but I'm just giving you a wild example. Okay, so if the inflation shoots up to, let's say, 10% and your FD returns are 7%, so you're losing 3% on your investments, on your principals itself, because the purchasing power decreases due to high inflation. So, as I mentioned before, inflation is one such parameter you need to keep a constant check on before you make any kind of investment decision. Okay, so from there, let's move on to the next, the tax implications. Bank fixed deposits have no benefits like those offered by other investments like mutual funds or stocks. These tax benefits can make a big difference for investors who qualify for them. So the returns that you get, let's say as I told you, the 6,000 rupees in our previous example, that is taxable under the bracket that you fall in. So depending on your income tax slabs, these FD returns are taxed. Okay, so there is no tax benefit on FD returns. So a few slides ago, we saw that we can invest or open a fixed deposit account in banks, right? So there are two different kinds of banks. One is a PSU banks, which means a public sector undertaking. Okay, it's simple words. It means uh, the the stake of the government in these banks are more than 50%. Okay, so usually these are government banks. So also termed as a public sector unit, is essentially established to have enterprises under the government, either central, territorial or state government. Okay, and public banks usually have lower loan interest rates and better loan terms compared to their private counterparts. So if you want to avail loan, let's say a personal loan, car loan, or even a home loan, housing loan, any kind of loan, usually the interest rates are relatively lower compared to the private banks. Okay, but however, one major disadvantage of public banks is that they are slow in the adoption of new technologies as compared to the private banks. But again, even this is slowly changing in our country. So public banks are slowly catching up with the private banks. Okay, in India, as we speak, we have 12 PSU banks. Let's quickly go ahead and check the name of those 12 banks. Okay, let's quickly go ahead and look at them. Number one, Bank of Baroda, Bank of India, Bank of Maharashtra, Canara Bank, Central Bank of India, Indian Bank, Indian Overseas Bank, Punjab National Bank, Punjab and Sindh Bank, State Bank of India or SBI, Union Bank of India, and UCO Bank. So these are the list. This is the list of 12 public sector banks. Okay, so let's move forward. Yeah, these are the logos. And now from public sector banks, we are moving forward to private banks. So private sector banks are privately owned. Okay, public sector banks prioritize social objectives and public welfare, while private banks or private sector banks aim to maximize profits. Okay, the first reason is the swift service provided by a majority of private banks in India. They are also providing customized financial plans to cater to the needs and requirements of the customers. So, as soon as you get into the bank, yeah, I mean, depending on how good your financial transactions are, you may be assigned a personal manager, a wealth manager, or a financial planner who'll suggest which stock to buy, which asset class to invest in, what are the interest rates. So, the service usually provided by private banks are slightly better. Again, as I mentioned earlier, public banks are quickly catching up. Okay, so private sector banks, as we speak, as I told you, we have 21 different private banks as on April 1st, 2024. So let's quickly go ahead and see which are those private banks. Number one, Axis Bank, HDFC Bank, ICICI Bank, CSB Bank, City Union Bank, IDBI Bank, Dhanalakshmi Bank, IDFC First Bank, IndusInd Bank, DCB Bank. We also have Federal Bank, Bandhan Bank, Kotak Mahindra Bank, J&K Bank, Jammu and Kashmir Bank, Karur Vaishya Bank, Karnataka Bank, RBL Bank, Yes Bank, South Indian Bank, Tamil Nadu Mercantile Bank, Nainital Bank, and this is a list of private banks that we have in our country. Okay, so from there, let's move forward and see what an NBFC stands for. In India, NBFC stands for non-banking financial company. Okay, so these are financial institutions that provide services similar to the banks, such as giving loans, offering credit, and providing investment options, but they don't have a banking license. Okay, so they cannot accept deposits from the general public like the traditional banks can. So that's a major difference between a bank and an NBFC. So NBFCs can do things like finance business, they can offer personal loans, they help people buy homes or vehicles, and even help manage investments. Okay, so don't worry, even an NBFC is as safe as a bank because they are also regulated by the Reserve Bank of India, RBI, to ensure they operate in a safe and fair manner. So in short, NBFCs are like banks, but with some important differences, mainly in how they get the money and what they can do with it. Okay, so hope NBFC is clear for now, right? So as of 2024, India has around 9,480 non-banking financial companies, NBFCs, registered with the Reserve Bank of India. The top 10 NBFCs are just, I mean, obviously I cannot go ahead and cover the entire 9,000 odd NBFCs. So let's pick the top 10. LIC Housing Finance, L&T Finance Holding, Aditya Birla Finance Limited, Cholamandalam Investment and Finance Company Limited, Mahindra and Mahindra Finance Services Limited, Bajaj Finance Limited, Tata Capital Finance Service Limited, and Shriram Finance Limited. So this is the top 10 NBFCs in India. Okay, and there are many more. As I told you, I cannot be covering 9,000 odd NBFCs. So with this, friends, we come to the end of today's session. And before we call it for the day, I just have a quick word to say. A recent SEBI survey from September 2024 showed that many people, especially the young investors, are losing money in the stock market. Right? It's high time to change that. When you lose money, you're losing valuable time on your path to financial freedom. So let's avoid speculative trading with instruments like futures and options, because these F&O instruments were initially introduced as a hedging mechanism and not a way to make quick profits. Okay, so true wealth is built through careful investing and not by speculation. So I encourage you to take a step back, reflect, and if needed, please hit that reset and start afresh. Okay, so it's okay even if you've had few losses here and there. We will cover all those up by doing the right things and the right way. Okay, so let's do it right and build wealth one step at a time, my friends. Okay. Before I let you go, I just have one last request from you. Kindly subscribe, like, and share this with as many people as you can, especially the younger generation, from kids starting from high school all the way up to the college, and people who have just started their careers, because we are going to be covering very exciting and very important topics which will help all these people with their financial journey. Okay, so the video that you're seeing right now, just below that you see the subscribe button, right? This button. So just click on that, hit the subscribe button and click on the like button. And once you do that, I mean, if you also like the video, kindly share it with your friends and family members. Okay, and once you do that, you will see this button changing over to something like this, subscribed. Plus you will also see this like button highlighted like this. Okay, so when you click on subscribe button, you'll get these options. You have to choose on all, which means any video that I post henceforth, it'll reach you on your cell phones or your systems. Okay, and by liking the video, what happens is if tomorrow somebody wants to learn the basics of finance or investing or FDs or any other topic that we are going to be discussing or we discussed so far, this video will be shown to them, and that's exactly how the YouTube algorithm works. Okay, so I request you to kindly do me this favor, and if I've done something wrong, or if the way I've spoke, or if there is any grammatical mistakes or any other shortcomings, I kindly request you to forgive me. This is my first video. I will try to improve on during the future upcoming videos. Okay, so having said that, please don't forget to remember the KyebyeWay, which is know your exit before you enter. And that's it. That's it, folks. Thanks for your time. I know it's been a long video, but from next video onwards, it's going to be a lot more shorter because I'm planning a 30-minute video instead of an hour video. Okay, so looking forward to staying associated with you people. So take care. God bless. Jai Hind.